just to get a quick take, who has no idea what a synthetic asset is, either in crypto sense or in financial sense in general? Cool. And who is kind of curious about it, heard some things, and just wants to learn more? All right, so you're not going to learn everything in the next 25 minutes, but hopefully we're going to get you guys to a place where you're well equipped to understand who are some of the leading projects and be able to ask better questions. So this is a panel. So we have some of the leaders who are working in Synthetix here today come up in a second. For those of you guys who have never heard the term, I'm going to do just a super quick 30-second level setting, and then maybe they can correct me. So if we're talking about a share of Berkshire Hathaway, for example, which is an asset that costs somewhere around $100,000, and that's the only unit in which you can buy it, that's obviously not accessible to a lot of people. So you could issue a different type of asset that is denominated in some percentage of what Berkshire Hathaway costs, and basically you can buy $1 of it or $2 of it or whatever else, which obviously opens the opportunities for people to own something that's backed by the price of Berkshire Hathaway, but accessible at a much larger set of markets and budgets. So that's kind of where we're going to start. That's all I'm going to say, and then I'm going to turn over to the experts. So Kane, Charlie, Alison, you guys come on up here, please. And Madison, I think, is running late, so unfortunately I have to start without her.
Okay.
So just to begin, can you super quickly just give us who you are, who you're with, what your deal is?
Hi everyone, I'm a partner at Paradigm. We're a crypto investment fund. I spend a lot of time on the early stage side of things and have focused on, unintentionally focused on DeFis and Synthetix over the last 2 or 3 years pretty closely.
Kane from Synthetix. We started off as a stablecoin project and kind of evolved as the market evolved and the market shifted towards a synthetic asset platform. So we now have a DEX that allows you to trade synthetic assets like synthetic Bitcoin, synthetic BNB.
Hey guys, my name is Allison. I'm one of the co-founders of UMA, and basically we've built a decentralized financial contracts platform that lets anybody create synthetic derivatives on pretty much anything using any margin currency they want. And then we're also contributing to decentralized Oracle research.
Awesome. So Kane, your company is called Synthetix, so you're probably the best person to correct or add to my definition. What is a synthetic?
I thought it was a good definition. In fact, I really like the Berkshire angle as well. We should totally do that. I think accessibility, that's a bit of an edge case, right? Like a single share is $100,000. Shares are not divisible, but in our view, a synthetic asset is certainly a synthetic asset on Ethereum, which is what we're building on. Is kind of any asset that is tracking the price of an asset that is not on Ethereum or even potentially on Ethereum, and allows someone to have exposure to the price of it without actually holding the underlying asset.
Is that what's also known as a derivative? Is a synthetic a derivative? Just for all of you guys, where does the line start between a stablecoin, a derivative, and a synthetic?
Yeah,
if there's a line.
A derivative always has someone who's a derivative always has somebody who's long and somebody who's short. So the way I think about a synthetic asset is just take one of those positions, either the long or the short, and all the margin and associated obligations with that account, and in our case, tokenize it for distribution.
Does a synthetic asset always have to be collateralized? Is that a feature of it? Is that a
It's kind of a deep topic, but I would say so far today we've been able to build pretty interesting things with fully collateralized protocols, and I actually think we're still very, very early in understanding how far you can push that. Some of the team at Maker and others have put some really interesting work out on sort of what being fully collateralized means in an abstract sense, how far can you push this? Can you share liquidity between different synthetics through a clearinghouse like Maker? Does it make more sense to structure them as independent ones? I think practically as of today, we have 500 projects working on identity on Ethereum and none that work at all. And so it's probably going to be a long time before we have the ability to assign any kind of credit risk on an individual level. So for any users that are using synthetic asset protocols today, I expect they'll remain fully collateralized for the most part on at least one side. But I think, and before we get to the point where we have like actual credit in the ecosystem, you'll probably see people issuing credit to DAOs like Maker or others where they have some notion of like identity and a Schelling point around them. Meaning, concisely, if you were to offer to sell me a bond today as an anonymous Ethereum person, there's no way I would buy it because there's no way I would underwrite your credit risk. If MakerDAO as a community were to say we're going to issue bonds in the form of a token right now, I would probably purchase it. Like I would be able to assign some credit risk to it. So like TLDR, uncollateralized synthetics or uncollateralized derivatives are probably, I bet they get issued by like DAOs and like credit starts with organizations instead of individuals.
So you talk about users. You guys both run user-facing platforms. Who are the users of Synthetix today? And who do you want the users of Synthetix to be in the near term? Who is the platform accessible to?
So for us, as I said, we started out as a stablecoin project,
Yep.
And I mean, you can see my shirt. It's kind of funny, but like Tether is kind of like a synthetic asset.
How do you feel about Tether?
It's cool, I guess. So like I think the issue you have is there's kind of two sides to this, right? There's this credit risk, this counterparty risk, like who or what is providing the value, right? And then you've got this other aspect, which is where is this price feed, or where is the mechanism coming from that's determining the price? Is it an auction mechanism, an open market mechanism, like is it being traded? Is it an oracle? Which I think most of the cool stuff happening at the moment is around like this oracle problem. We have the oracle problem, a lot of people have it, and it's something that I think needs to be solved. But you've got a few different components that kind of come together to give you an asset on Ethereum, as an example, like synthetic Bitcoin, and to kind of contrast that with wrapped Bitcoin, which is another Bitcoin implementation. One of them uses Bitcoin in custody for BitGo and some various other components to give people price exposure to Bitcoin on Ethereum, which is a nice thing to have because you don't need to leave the Ethereum ecosystem and you can get exposure to the Bitcoin price. With us, we use an oracle to get the same kind of price exposure without actually having custody. And those are kind of two different approaches, but you need those three things, right, to kind of get this thing. But to come back to your question of like who's using it, I think right now and for the foreseeable future, like speculation is still the main use case. And so for us, we've kind of gone into crypto synthetic assets, so like inverse indices of Bitcoin, ETH, and BNB, as well as like long tokens. So people want to be able to trade that kind of thing because it's speculation, right? And that I think in the short term is where we're going to see the most activity. But things like equities, being able to hold Apple shares or Tesla shares or Berkshire shares on Ethereum are really cool. But I don't know if we're quite there yet for users to come into that.
Cool. So I want to come back to the Oracle problem because I think it's fascinating and maybe explain it to the audience a little bit. But before that, Allison, do you agree, and how do you see the use cases maybe geographically and demographically?
Sure. So we think of ourselves as being a B2B2C platform. Our ultimate success depends on end users actually finding utility from our protocol existing. But currently the level of financial sophistication that's required to interact with our protocol is somewhat high, right? Like even a really simple financial derivative carries some risk, and it's not quite a system where we feel like it would be in the community's best interest to be like literally completely permissionless right now without further education. So right now the users of our system are basically financially sophisticated like funds, market makers, other liquidity providers that want to create some sort of financial derivative that now find it easier to do so using our infrastructure. And ultimately they're the ones that are meeting real end user needs, which as Kane mentioned, given the current kind of user base in crypto, typically centers around speculation and volatility. But I definitely think that kind of longer run, if we really want to get kind of broader adoption, mainstream adoption, it's not going to be through these mega volatile assets, but really rather through genuinely stable, censorship-resistant, yielding, store of value, and other sound investment products.
I'll give a controversial response to that. I would say I agree with that in the long term. However, today what is working looks a lot more like gambling than building normal financial products. And there are some interesting, like, the specifics of like what we're required to do today do give like a pretty good intuition for why that might be the case. So like, let's think about people have built option protocols on top of Ethereum today, and none of them, like there are no options on top of Ethereum today. There are option protocols, but there are no options. And why is that? Like for the most part, people don't really care about these types of products where like the payoff bounds relative to the fact that you have to fully collateralize these things, like no one really cares. No one's willing to take on the opportunity cost. No one wants the premiums. They're so small. Arthur Hayes wants to build knockout barrier options for Ethereum, which are basically just gambling. It's the equivalent of Ether's at $200. I'll set a knockout barrier at 1,000 at 5% today. So I'll give you a 20x payout on 1 Ether for a 5% premium if it breaks $1,000 in the next year. That's like a gambling contract. It's not like a normal financial product.
It's hedging. It's hedging.
It is hedging.
I'm joking. It's
it could be. The point I would just make is, for better or for worse, both in terms of what users want and just structurally, like how much inefficiency there is to like the actual transaction costs in the system, not having access to credit, literal transaction costs on top of Ethereum, like how frequently people want to be transacting in these markets and how efficient they can be. Like clearly the market is pushing us towards, lotteries at this point, like those kinds of products. And I would expect that those are the things that work in the near term.
Got it. So I want to come back to another huge potential inefficiency, another problem in the space called the Oracle problem. So just to get everybody in the room on the same page. So let's say that Kane's company Synthetix, they have an asset that is mapped to gold. So essentially they collateralize something and 1 unit of that, I think they call it synths. 1 synth is essentially equivalent to 1 unit of gold. Somehow they have to get the price of what gold is in the commodities market, and usually that, or metals market, and that will come from an oracle. So another company could pop by and also have a synthetic asset that also represents gold, and they could collateralize it similarly or differently, but they'll have to do it equivalently, presumably. But they might use a different price oracle. There might be web network latency issues. So the actual price of these synths might not be the same across every synthetics provider in the world. So to turn that over to you guys, how is that problem playing out right now? What are some of the solutions? Is that something where you think developers should focus their attention?
I'll give a super quick. Great. Like different synthetics issued by different issuers with different characteristics should trade at different prices. Like even with the same price oracle, like if you are going to underwrite different levels of credit risk to different issuers, for example, a maker and a maker competitor, like clearly DAI and DAI competitor version like should trade at different prices, and the oracle component is like, in our opinion, just a crypto-specific example of like credit risk or the types of things you normally underwrite. Yeah.
I guess I'm going to back up and kind of frame the oracle problem again. So I actually see it as kind of 2 problems. One is literally defining the data set and getting it securely from wherever it currently lives onto the blockchain in a usable format that smart contracts can interact with. And the other is really around recourse, upgrades, arbitration, etc. So if you think about kind of like your traditional financial world, derivatives exist. All those derivatives also need oracles from the fiat world. And basically what happens is that generally speaking, people find themselves able to come to an agreement either through natural language or some standardization that's happened over the years. But they also know that if there's a disagreement, they can go sue each other. And that's actually kind of what makes financial products historically really hard to transcend geographical borders, and the paperwork and all that other stuff that's required makes it really hard to kind of serve slightly down, slightly lower on the financial pyramid. So if we take all this stuff into kind of the blockchain space, like lots of solutions currently exist for or are in the works for how you create, fault tolerant, safe, secure ways of getting data from point A onto the blockchain. But I see kind of the problem that needs more solving, and what we're working on at UMA around like arbitration and recourse. So we kind of think of it as fundamentally, any oracle that you build, no matter how robust or well-designed or whatever it is, there's probably some configuration of the world in which it can actually either become corrupted or just no longer relevant. And so the system that we've built is basically like a system that uses economic incentives to ensure that any corruption that you try to engage in on an oracle will actually be economically unprofitable if you buy into our recourse system.
So yeah, I'll just step even like one step back from that and say, I think fundamentally the issue is you have the real world, right, and then you have this trustless world, or what should be trustless, and you're trying to join them together, right? And it's a question of the trade-offs between how much do I as a user of this system want to trust where this data is coming from, the oracle, and so you can have mechanisms where there's arbitration and recourse and all those sorts of things, but ultimately what we really want is a trustless oracle, right? Because that's where you're kind of breaking the system, right? You're putting these assets into a trustless environment, but then there's this like thread of trustfulness that kind of connects back into the real world. And it's a hard problem. There's a lot of people working on it. I know Hayden's working on some stuff for crypto assets. There's Chainlink is working on different mechanisms. You guys are working on it. For us, it's not a problem that we are trying to solve directly. We've kind of just put up our hands and said, we've got a proprietary oracle. It is trustful right now. It allows the system to work. The system's very experimental. It's small scale. And we're working as quickly as we can to kind of move away and sort of edge away from that trustfulness. But that's the fundamental issue. We want a fully trustless system that's self-contained, and that's a hard thing to do when you need information from the real world.
Do you guys, sorry, I was going to just follow up directly. Do you think there's a sort of an arms race that's going to happen for who is going to be the decentralized oracle of choice?
I hope so. Keep working on it.
I think there's like a fairly decent chance that there's no optimal design for this, that it's in the same category of problems as like quote unquote like incentive compatible identity, which is like very probably just like not a tractable problem. It's more of a like heuristic solution problem, and people will continue to pick like the best available option for them at the time. So if you look at like Augur seems like reasonably okay as a very like good, like it probably works on like a pretty low resolution or like low tick frequency timescale as an oracle. Like yet to see anything that's not at least somewhat trusted that like pushes it towards like what we want as like a general decentralized oracle. Now that being said, even if it's not possible, like Maker exists today and it works. Like we have a clear path here of like we this is not the hill we need to die on in trying to build these products. And if in 5 years we get to the point where we have the arms race and like we've been trying to create a perpetual motion machine, like would that be the end of the world? No, probably not. Like all this stuff would still work. It'd be a little heuristic and annoying, but it would still work. And not to say that we shouldn't attempt it, but just like this is, I do not view this as like if we don't figure this out, like none of this matters. Or yeah.
I mean, I guess the way that I kind of think about it is that a fully trustless decentralized oracle matters only if it's being used for something. And even though we all say like we all have the oracle problem, all of our contracts need an oracle, it's kind of like most projects are focused on delivering product to meet end user cases first, and then going back and figuring out more robust oracle solutions, more decentralized oracle solutions for it later.
So for those of us in the room that are interested in sort of how crypto will affect global financial systems and flows, if Synthetix, because they're so open potentially to everyone, they could actually become higher in volume than a lot of the underlying assets that they're derived from. So if you have more synthetic gold trading all over the world globally than you have gold, are you giving the ability to traders of those synthetic assets to actually affect the price of the underlying commodities? So if all the synthetic traders short gold synths, is the price of gold possibly going to drop?
I mean, you already have that, right? Like that's it. Like that is the reality we live in, right? So I guess the question is, do we want to transplant that reality where synthetic versions of gold futures, etc., are traded in an open market? And like we're kind of seeing this interesting thing at the moment. We've got a trading competition where people are trading, and they're trading on Ethereum. So everyone who's in this competition can see all the positions of everyone else, right? And they're using that information to kind of see where is the market going, like what's happening, and that kind of transparency I think is really powerful. And the fact that you don't have a central clearinghouse or need for arbitration, etc. Obviously, there's trade-offs, but I think a marketplace where it is much more open and transparent what's going on will be very powerful, because that's the status quo.
I give two answers on this. The first would be yes, absolutely, synthetic markets impact physical markets. Like look at BitMEX, or gold, or silver, or whatever. Like pick a market in like weather futures. So you don't actually affect the weather, but whatever. Like same way. Like of course that's going to happen, and I think the crypto part of it is an interesting argument, because the reason, like the amount that these synthetic markets unduly, or like the amount they influence these physical markets, not entirely, but largely, is about the like inherent transaction costs to the physical markets themselves. And so it's like, why would I take out a synthetic dollar-yen loan as a Japanese company as opposed to like actually going to access U.S. credit markets, like dollar terms? Transaction costs, largely. Same thing with like physical gold trading. The fact that in like the U.S. equities have this like regulatory mode on settlement that sucks. Like that's why generally like the size of synthetics on any given market is related to the transaction costs underlying that actual market, and like how much inefficiency there is in them because of that. Like that is a problem, but whatever, it's one that's always existed. So in this case, I mean, 2 points here. Crypto is interesting because the underlying assets, when they are actually like crypto native, have substantively lower transaction costs from a market efficiency perspective than like any physical markets do. And so you should see that effect less in crypto markets than you do in traditional markets for the most part. And then two, like it's pretty clear, I think, at this point that this is the way that we like get to scale and integration with traditional markets. Like I think it is far more likely that like the graveyard of securitizing, traditional equities, protocols, whatever things, like that in 5 years from now we look back on that as the graveyard and say like, oh well, the way that we actually started influencing traditional markets were synthetics on like a Bolivian real estate index. That is like totally just people wanting to put on risk positions without needing to like deal with any of this legacy stuff, like, and all of the like headaches that entail.
Cool.
And I mean, it also just kind of comes down to use cases. So in your traditional fiat world, most major institutions can access any number of derivatives or the underlying spot markets, and yet you do actually see arbitrage opportunities exist and continue to exist for some period of time, either because like even in the crypto world, sure, transaction costs are lower, but like there is still some cost integration and maintenance and like the development of the code and the testing of the code and all these other things. And the goal, of course, is for all of that to, with open innovation, be able to escalate really quickly towards robust solutions. But like, creating an index that just automatically replicates like 100 different tokens, 25 of whom are on their own blockchains, another 25 that are like staking tokens that have different staking protocols and requirements. Like that would be way more convenient than like literally going out there and doing that with 100 underliers.
Yeah. Cool. So before we wrap up, one last final question. You guys have been very helpful explaining synthetics to us. How can we be helpful to you? Who are you trying to hire, fire, fund, build? What is your priority, and how do people get in touch with you?
I'll just give an answer on something I'd like to see built then.
Sure.
Right now you have a bunch of protocols that are coming out where I think the best example of this are like 0x bundles and then token sets, where like you can create an equivalent product on both of them, but we don't actually have like a language by which to express that they're equivalent today or to prove it. You could say the same thing of like DYDX option protocols versus like, I don't know, we can go spin up one right now, Maker and DAI versus like a competitor or whatever. Like basically, I think the coolest protocol that someone could build in DeFi in the next 10 years would be like a language by which to express the equivalencies between different products. And then you can imagine something like, I forget the name, but the thing where you can do like flash lending on Ethereum today, where you can like essentially like do provable arbitrage, and then like we can all just throw money into a bank that's like, all right, we're only going to fund trades that like over some time period have like these risk parameters. I think that'd be super cool.
Cool. Kane?
Yeah, for us, I mean, we're live, right? So you can come and use Synthetix Exchange to buy some synthetic Bitcoin or Forex or gold or whatever. So yeah, come and use the platform, give us feedback, come into Discord, complain about stuff.
We will.
All the fun stuff.
Allison?
For us, I mean, we're hiring in New York and hackathon developers and DD. And a lot of what we're trying to do is really just think about ways to grow the pie. So we have, we're sponsoring a prize around who's going to hack the project with open financial innovation using blockchain protocols on the next thing that's going to get more ETH locked up in DeFi. So curious to hear what all of your ideas are.
All right, let's thank the panelists. Thank you guys very much.